Hey, you've got just a few weeks left in 2025 and the IRS clock is ticking. If you do nothing, you're locked into the tax bill you've already earned this year. But thanks to the brand new tax rules in the 2025 tax bill, I've got clients who will legally erase 5 and even 6 figures of taxable income in these final weeks of 2025 using Section 179 and 100% bonus depreciation, and a few simple moves that almost nobody's been talking about until it's too late. So in this video, I'm going to show you exactly how to do that before December 31st to put a ton of money back in your pocket. All right, let's get started. Okay, so here's the problem. Most investors and business owners don't think about write-offs until March of the following year when they're sitting in front of their CPA and it's already too late to do anything. The truth is that your 2025 tax bill is already being decided right now in the last 6 weeks of the year. And because of the new law that went into effect in 2025, often called the One Big Beautiful Bill Act, you've got bigger tools than before that we've seen in years. A Section 179 limit that jumps up to $2.5 million and the return of that very favorite one of mine, 100% bonus depreciation for qualifying property placed into service after January 19th. So what does this mean in plain English? Hey, if you make the right moves now before December 31st, you can possibly cut a huge chunk off your taxes this year down to this much smaller number. So in this episode, I'm going to walk you through how Section 179 bonus depreciation really works in 2025 and what you can still prepay in these last weeks to accelerate it, and how to clean up your vehicle, home office, and reimbursement strategy so you're not just giving away money. Okay, I'm going to keep this all at the federal rate, so nothing here is going to be state specific. So whether you're in Texas, California, or anywhere else, again, this is all federal. All right, so let's start with the big hammers here, the ones that are going to produce the most benefit. And of course, it's not going to apply to everyone, but that is Section 179 and bonus depreciation. This is your fast forward button for big purchases. So what do I mean by that? Well, Section 179 is a rule that says instead of depreciating certain business assets over 5, 7, or 15 years, you can elect to expense them in the year that you place them into service up to a certain dollar limit. So for tax years beginning this year in 2025, the IRS instructions on Form 4562 put that limit at $2.5 million. Now it states that it's to phase out dollar for dollar once your total qualifying purchases go over $4 million. So you got to look at what that spot is for you in your business. Now I know a lot of people are probably watching this thinking, hey, I'm not at $4 million. Yeah, but if you're at 300,000, that's still something you can't be missing out on. So when they say placed in service, and this is really where the issues oftentimes come up, because I've dealt with real estate investors who want to take advantage of what I'm about to share with you, and they don't understand that they actually have to put their property out into service, which means try to rent the property. And if they're not doing it, then it doesn't qualify. So placed in service means just what I'm saying. You're making the asset ready and available for use in your business. So if I'm a real estate investor like I described, that means it's ready for rent. If I have a asphalt business and I'm buying vehicles, then the vehicle is titled and delivered and the equipment is installed and working in my business. Okay, or maybe it's an improvement on your business, so it's already been completed and you're using it. Okay, just ordering something will not count. Signing a quote does not count, right? Or your contractor says, hey, we're going to start this in January, will not help you. You actually got to get this done before the end of the year. Now, you take 179 and you layer on bonus depreciation. This is where things get really interesting. You see, under the old Tax and Jobs Cut Act, the phase down schedule of bonus depreciation was supposed to drop to 40% in 2025 and then disappear. Now, for those of you that have assets that were placed into service, say in 2024, you're going to be under the old law. But for people who placed assets into service in 2025, which means you bought a rental property in 2025 or you're buying equipment here in 2025, meaning after January 19th, hey, we're back in business with the 100% bonus depreciation. That means a lot of short life assets can still be written off in the full year in which they're placed into service here in this year. So let me give an example. Let's say you've got an S-Corp. and you buy a heavy SUV for your business, and that's over 6,000 pounds, and that's going to qualify under the SUV rules, and the all-in cost for this SUV is $60K. So if you generally use it 90% for your business deduction is going to be $54,000 for that vehicle. So between Section 179 and the 100% bonus depreciation for that SUV, okay, you may be able to write off the full $54K in 2025 instead of spreading it over 5 years. So if your combined federal and state taxes around 30%, that one move could cut your taxes by $16,000, right? Something simple like that. And a lot of people miss this. It's just amazing. Now, if you add real estate into the mix, let's say you bought a small duplex this year and you do a cost segregation study on it. Now, if you're not familiar with that, I have plenty of videos on that strategy. So what a cost segregation study, really quick, what it does is it breaks your property up into different pieces. Okay, we look at it and we say, hey, what are some 5-year property, like our appliances, our carpet, 7-year property, like certain fixtures, which is going to be on the commercial side, and then 15-year property, such as land improvements, parking lots of landscaping, driveways, things of that nature. So what a cost seg study will do is it'll look at all your asset, break it all up into these components, and they'll say, hey, of those components that are 5, 7, or 15-year property, you're going to get an immediate tax deduction. So let's say I spent $500,000 on the duplex. It may have $80,000 or $120,000 in these components. And so instead of depreciating them over 5, 7, or 15 years, you get to take it all up front. So between Section 179 and bonus depreciation, what you're able to do is front load a ton of deductions. Now, this is very important, and it's something you do not want to miss. So what I mean by you do not want to miss this, understand this rule right here. Section 179, which I described, 5, 7, and 15-year property, the accelerated depreciation you can run on those things, that's limited to your business income. So bonus depreciation isn't. So you can't use Section 179 by buying equipment and writing it off to create a loss, because it's going to be capped by your net income from your active trader businesses. Bonus depreciation, on the other hand, can push you into a loss carry forward. That's why at year end, your advisor that you're working with, that's something we do here at Anderson, we have to decide which lever we're going to pull first. Are we going to go for the 179, or do we want to move through that and then look at bonus depreciation, which is going to then create losses to move forwards? So all this is very important this year when you're putting these things together. And as I stated earlier, it's something that many advisors are not aware of, and they end up messing up their clients' tax returns. Now, after you've looked at the big assets, the next move is to pull in the ordinary deductions, as many as you can. And I'm not talking about doing crazy stuff. Okay, I just basically there's loose dollars laying around on the table. Before the dealer walks away, you need to get in there and snag those, because they all add up. The small things do matter. So the tax regs have what is called the 12-month rule. So in simple terms, it means this. If you prepay an expense and that payment doesn't give you benefits beyond 12 months after the period begins, you're often allowed to deduct it now instead of capitalizing it. So let's say your liability insurance renews in January and your carrier will take effect for 1 full year, okay? So either you pay it in December, get the deduction now for 2026, or you wait until 2026 to pay it. Same idea goes for software subscription, service contracts. So I'll give you another example of this. So I was dealing with a landscaper for one of my properties, and we were talking just recently about his payment and renewing to work with him for 2026. I said, hey, what happens if I pay you today, this year? What type of rate discount would you give me? He said, well, if you prepay me for the entire year, then I will give you this rate. I said, done deal. Now, he thought he was getting the benefit by getting the money up front. For me, the benefit is by paying him now, I get to take the deduction in 2025. So this is what you need to be thinking about with your expenditures here at the end of the year. If you have income and you're trying to offset it, and you know maybe you're going to have CapEx on your property in 2026, it may be the time now to go ahead and start making those improvements to those assets to bring your taxable income down. and taking advantage of it right away rather than waiting. Why is this important? Because when it comes to your property, for example, repairs are deductible, but improvements generally are not. You have to depreciate them or capitalize them. So by using these code sections, you're able to get a deduction for it. So if we make the move now, we can get the write-off. So let me give you an example. So let's say you lined up $15,000 in repairs to your rental portfolio, and you've got $10,000 in insurance and maybe some market or some landscaping prepayments like I talked about that qualify under the 12-month rule. That's going to be $25,000 in ordinary deductions you've moved into this year rather than delaying paying it next year. At a 30% tax rate, you're just going to save yourself $7,500 in taxes by changing when you cut the check. So the other thing to keep in mind though is when you're doing this, don't buy stuff you don't need and get a write-off, right? I've talked to many people who say, well, I'm just going to go out and buy a truck and get this write-off. Well, do you need a new truck? If the answer is you don't need a new truck, then you're better off waiting and not making the expenditure. The smart play is buying the stuff you know you're going to need in 2026, pushing into 2025 if you have income that you can offset. Now, let's talk about the boring stuff, all right, that creates thousands in deductions every year for our clients. And those are vehicles, home office, and accountable plan. And this is where a lot of people are bleeding money because they don't have a system in place. Let's look at the vehicles. So the IRS cares about business use percentage. I showed you this example earlier, right? So you've got two basic methods when it comes to your vehicle. You have the actual expense method or the standard mileage rate. With the actual expense method, what you're doing is you have to track all your gas, your maintenance, your insurance, depreciation, lease payments, and you multiply it by your business use percentage. Now with the mileage method, what you do is you track your business miles and multiply it by the IRS standard for the rate for the year. Either way, you need a starting point, all right? So you got to have an odometer reading to say where you started, and then you have to have an ending odometer reading to show how much of your time was spent on business-related trips. Now, if you want to learn more about this, just go to IRS Publication 463. It spells all this out, black and white. It's so easy if you read it. Now, you can reconstruct a log of your vehicle using your calendar or other mapping apps, but it's so much easier if you commit to keeping track of your miles, okay, on a simple spreadsheet when you do it. Now, there's apps out there as well that will do this for you. When you get in the car, you just say, hey, I'm driving for business, and it'll track it all. But what's important here is that you need to keep track of your miles when it's still fresh in your mind. And there's been many audits where individuals have claimed great expenses because of the mileage deduction for their personal use car that they're driving around for business. But the IRS has denied it on audit because the mileage log was created months, if not years, after the claim deduction. Now, home office is similar. All right, if you're legitimately using part of your home regularly and exclusively for your business, meaning that room is actually your office and not the kids' playroom, and you just got a laptop in the corner, you can deduct the use of that portion of your house. Now, it's really simple. You can use the simplified square foot method, or you can allocate based upon actual expenses. Now, it's all about measurement and documentation. What I would typically tell my client to do here at Anderson that's working with us, I say, hey, go out and measure the room, document what's in it, take a few photos to keep as backup in case you're ever challenged. And then what you're going to do from there, you're going to look at your rent, your mortgage, your interest, your utilities, and your repairs, and you're going to take a percentage of that based upon the square footage of the property that you're using for your actual business. And the picture stuff, I tell you, it's really important that you have that, because if you do get audited, they're going to want to know it's not your kid's playroom that you're trying to claim as a business. And that's an easy one. Now, the next big one they miss is that a lot of business owners, they're set up as S Corps or even C Corps. And so if you run your business as an S Corp or a C Corp and you're paying business expenses personally, such as mileage, cell phone, home internet, tools, things like that, and the corporation is not reimbursing you under what is important, you have to have here an accountable plan, you're almost certainly leaving a ton of money on the table. And this is where you got to keep the copies of the receipt. And then keep a written log of what you're doing on behalf of the business. All an accountable plan is a written policy where your company agrees to reimburse its employees for their business expenses when they provide receipts or logs. I just dealt with a client in this situation where they had a management company set up and it was providing services for the business, but they didn't have an accountable plan in place. And so all that money that was being paid back to it technically could not be written off, and it was causing a fit for their CPA. And I said, hey, we need to get an accountable plan in place to make sure this is deductible. The company gets a deduction for what it pays. You don't have to take into income the money you receive because it's not income. All you're doing is being reimbursed, okay? Under an accountable plan, the money you receive from your business, it's not wages. So if you're watching this in the final weeks of 2025, you can still put an accountable plan into place, document your policy, and start those reimbursements before year end, right? You won't be able to magically reclassify everything you did all year, but at least you can get in place and say, hey, yeah, a lot of these things, go back and pick them up and drag them into 2025 so they can help you here. So quick recap, final weeks of 2025, you still have time to move the needle. Use section 179 and 100% bonus depreciation on assets you actually need and can place into service before December 31st. Do not miss that deadline. Look at prepaying legitimate 12-month or less expenses and pulling forward repairs or things you're going to do anyway in 2026 and get them done now. And more importantly, clean up your vehicle, home office, and reimbursement strategy with an accountable plan. So basically, you're not throwing money away on deductions that you're missing out on every month. This is all the low-hanging fruit that when we sit down with people and say, hey, we look at their taxes and we show them how much they missed out on by just making some simple moves, they're astounded. And they walk out of the office kicking themselves, wishing they had this information sooner. So if you're saying, Clint, I get the idea, but I have no clue how to actually implement this, okay, or how it applies to my LLCs and my rentals or my business, that's exactly what my team at Anderson here does all day long. We sit down with investors and small business owners just like you. We look at your structure, your books, and your numbers, and we help you build a year-end plan that fits your reality. Listen, if you want to set up a free strategy session, in the show notes below, there's a link. You can click on that link and you can set it up with one of my team here at Anderson and bring your year-to-date profit loss, bring your entity structure, a rough list of what you're planning to do, buy, repair, and we'll show you where the big levers are before December 31st to lock in this year's tax bill. Take advantage of it while you have that opportunity before the time runs out. I wish you the very best with your investing and your business.